aren't we?
We are. Uh, Winter in the northern hemisphere, I'm sure, is closing in as we are still enjoying warmer temperatures here, warmer than wanted. Let's put it that way. Um, okay, if you're ready, we'll kick
Yeah.
off the podcast recording. Um, 5, 4, 3, 2, 1. Good morning and welcome to today's Daily Energy Markets podcast. It is Sunday, November the 13th, and it is halfway through the final quarter. And my sense in this Sunday show, where we get to slightly have a week in review take on things, that somehow the sentiment felt like it shifted last week, and I'd just like to dig into that a little bit. The idea of the inflation numbers in the core inflation in the US signaling a backing away from the sort of robust rate rises that we've seen there. Also, the China starting its slow but obvious reopening or easing of COVID, giving the oil markets a sense of optimistic outlook. Let's kick off with Adi Imsirovic, Senior Research Fellow at the Oxford Institute for Energy Studies. Your thoughts, Adi, at week in review of these possible shifting moments or not?
Morning, Sean. Shifting moments, well, I guess we'll have to find out. Totally correct. I think the key things that have been depressing the oil market for the past a few months have been interest rate rises in the US and the Fed policy. I think I've said many times that commodities don't like high interest rates. You have to borrow the money and invest into something that may not give you any return whatsoever. So that's very important. The inflation numbers were rather positive, pointing that the core inflation may not be as bad a problem as we thought. But that's still not sort of jury's out there on that one. I've seen slightly contrary views as well, given the sort of labor market still remaining fairly strong in the US. China is a big thing. We always know that sort of China as the biggest marginal buyer out there in Asia is the driver of demand. And these policies, it was a little bit confusing last week, wasn't it? It was first China said, okay, the news were about easing of the COVID policies. And then one of the officials came out and said, no, that's not the case. So the market came off a little bit and then ended up on a positive note on Friday. So there are some very positive news, potentially positive news out there in the market from last week to expect that they could support the market in the coming weeks. But I think what we keep forgetting is that seasonally we are at that time of year where China would come back into the market and start buying whatever, simply because we're going into the Chinese New Year, buying for the Chinese New Year and stockpiling for the Chinese New Year. So we do have to expect some strength coming out of China, regardless of the economic situation. As a result, I think the market fundamentally has been fairly strong anyway. Judging by the spreads, by the differentials, by the CFDs and so on. Brent Dubai is still very wide. Brent WTI is still very wide. There are a lot of positive signs out there, but we still have to see whether these two big factors are going to materialize.
Let's welcome Rachel Ziemba, founder of Ziemba Insights and an adjunct senior fellow, Energy Economics and Security Program at the Center for a New American Security. Rachel, just taking those two main points, starting with the US, I mean, from a distance, the US economic outlook is quite confusing. It's like full employment, but yet the economy is, people are feeling bad, and now we're getting the inflation rate apparently coming off. Your thoughts on whether that's a tipping point moment for the outlook for the US economy?
Sure. So I'd have to agree with Adi on this sort of mixed story, right? Might be sort of turning here, but I also think we are starting to see it's very sector dependent. the technology sector and others, and even property markets, of course, very interest rate sensitive, that are softening and will continue to soften. So I think, in a sense, my worry is that markets have become a bit over exuberant a little too quickly on both of these topics. We're thinking of this sort of, if anything, maybe starting to sort of price in quick reopening in China, which I'm skeptical of, particularly given the COVID surge that's going on right now today. Optimistic about next year a bit more. But I think in the US, I think we're still seeing a slowdown. Right. And I don't think it's so much of a slowdown. The Fed is going to completely change course. So it's positive that we don't have as much feed through to sort of new surges in inflation. But we also have to recognize that some of what the data we're seeing now is from periods of time where food and fuel prices had started to soften earlier this year. So when I look at wage demands and the like, this is still definitely, this is a more manageable core inflation outlook, but still not one where there's a deflation risk. And so I still see higher rates ahead, maybe not as much as people feared. But this is a Fed, if anything, having been caught behind the curve, that doesn't want to fall further. And that, I think, is going to mean that some of this recent softening of the dollar might reverse. On the oil sort of market side, I think, just to sort of reinforce maybe a point Adi made about the seasonality trends, I'm watching very closely not only China's actual demand, but their willingness to sort of boost refinery capacity, refinery throughput, because that's been something that's been a positive sign. That's been something that's been a positive sign for demand. And I think that's probably likely something that's going to continue going into next year. Of course, that would be a positive sign for some of the refined product spreads. Sort of bring them in a little bit more. It's probably a little too soon to see much tightening on the diesel side, but those are some of the things we're watching. Also, finally on the U.S. side, of course, tonight brought some clarity on at least one of the houses of Congress, which will stay probably in the Democratic hands. I think that, if anything, the mixed government we're likely to see probably means there's a lot less U.S. fiscal room for any new expansion. So that, I think, we already have there's a lot of stories baked in with the IRA, with the CHIPS Act, some greater sort of investment from the U.S. government coming through to keep the U.S. growing stronger than its peers. So I think this is still a mixed outlook. The U.S. still doing better than most of its G7, G10 sort of peers. But this is a global economy that still looks pretty weak, in my view.
Looking forward, Adi, I mean, the what we're kind of arguing about here a little bit is maybe the timing, but the trend lines, we're closer to the end of massive rate rises in the Fed than the beginning. We're closer to China reopening, moving beyond its very strict COVID policy. Yes, timing of both of those journeys is obviously very important, but nonetheless, the journey seems quite clear. And with it, demand for energy on an upward motion, one would think, in both cases. Yet OPEC is just at the beginning of a fairly robust cutting cycle. I'm wondering, from your point of view, are those two things aligned?
Well, it's hard to say. I think it was a couple of days ago, it was Prince Abdulaziz, the oil minister of Saudi Arabia, said the jury's out there. We just don't know. He was looking at these exactly very same factors, including China. It's hard to say. Let's not forget, before we get too bullish, I mean, the cycle of big interest rate rises might be coming to an end, but it doesn't mean the interest rates won't rise. They probably will. Secondly, they're already at a lot higher point than we were. Again, not particularly good for the commodities and the sort of a fintech and tech sector anyway. And we see that in the tech sector, even though it rallied, came back a little bit on Friday. So that certainly is going to subdue demand. The second point, I think, what Rachel said is very, very important. We tend to talk about the US quite a lot, but let's not forget that Europe is almost certainly going into recession. UK had a negative growth in Q3. Europe will almost certainly have something close to zero. We'll see the numbers. I haven't seen anything yet. So the rest of the world, which is very, very big and very important, is still not doing particularly well. China China is not just the story of COVID. China is also a story of subdued growth due to their sort of subprime situation as well. So we have that problem is still out there. And I think even though that a few observers have mentioned that we could expect some stimulus package coming out of China, it's not going to be that easy for them, Sean. It's not going to be that easy with this property situation in China, fueling a bubble. And Chinese know very well. Chinese officials know very well. It is a bubble over there that needs to be slowly deflated. Otherwise, it could blow up in something a lot bigger. So I wouldn't get ahead of things too far. And this is so far, Sean. We've talked about the demand side of things. We haven't spoken about supply side of things at all. And now we will. I'm sure you'll come back to Russia. But one point that we haven't mentioned.
Well, I did ask about supply side at the top of this question, which was: is OPEC Plus move into a cut cycle while we're having, China reopening, whether it's slow but gradual, but it is a direction of travel, and yet we have this relatively robust OPEC supply cut, whether it's half of the 2 million or whatever, it's still a trend line of a very tight market. And that sort of was my question, whether they would need to ease up on that a little bit.
Well, they should ease up. We know that. We knew that even before they decided on that cut. So obviously, there's no doubt that OPEC Plus want to have oil price above $100 a barrel, and that's the aim of that cut. Whether it's a real cut or whether it's just Joe boning or talking the market up, we'll find out. But the point is that we shouldn't have been there. It's really not helping the economy at the time when the economy actually probably needs some cheap fuel.
Rachel, I just wanted to bring in Rachel on this China question before we drift away from it a bit. What I'm struggling with a little bit, and I think we're seeing it in the coverage, is China's decision regarding COVID opening a how do we save face for the new King Xi and manage that perception, or is it actually a very serious health risk for a unvaccinated economy? How do you see those two things influencing the decision making?
Sure. So what I think we're seeing right now is a signal from the central government that local authorities should be maybe more targeted in their lockdowns, right? We are seeing some opening, but a lot of it is saying, don't shut down the whole city. Don't test everyone if there isn't really a pickup in COVID, right? Which, again, for the rest of the world, this still seems like sort of, and will continue, I think, through much of next year to seem like quite an extreme, sort of lockdown. But as we said earlier, jury's still out. But I think, as is often so important in China, it's this direction of travel of don't try to outcompete other cities in the depth of the sort of COVID lockdowns. And at the same time, so I think there are things like reducing the quarantines and not slapping on additional ones that may start to mean we start to see a little more travel into and out of China. But I think it's going to be quite slow. And that is a function of both what is a resurgence, but the fact that especially among the elderly, China is still relatively unvaccinated, and some of that vaccination status is waning. And while there's a little bit of flexibility here, maybe with some foreign and other mRNA vaccines, I think that this is going to come, any opening is going to be a little slower than markets expect. And I agree wholeheartedly with Adi that there's probably not going to be a lot of other sort of stimulus. If anything, for the last couple of years, maybe even longer, markets spring eternal on stimulus. They look back to a decade or so ago. And I think we look at the sort of loans the Chinese banks are extending, this sort of very modest. The demand for additional capital is not really there. And this is, of course, in a country where yes, there are these sort of concerns about tech sort of sector dynamics as well as property. Now, of course, there's some sectors, including as part of the tech sector, that will get some government support. But overall, I think this is one where China is still going to be pretty circumspect because they don't want to make their debt issue even worse, right? And so that, I think, is going to be, is going to be put a cap on this. But back to what you were saying earlier in questioning on OPEC Plus, what struck me at the last decision was not only the sort of symbolic and important direction of travel of cuts, but that they thought that they were going to maintain that somewhat lower production level. I mean, maybe half of the headline production cut, because the rest of it wasn't already happening, but throughout all of next year, right? And so while we might sort of quibble on sort of the signals and dynamics of the market, that seemed to me to be very much at odds with their own internal forecasts of economic growth and activity, and so that it may not be a risk right now that OPEC Plus is cutting into a growing economy, but sort of later into next year, I think we might sort of need to see a reassessment. And of course, there's the big elephant in the room of how the sort of EU embargo and the price caps and all of that go. My feeling is that sort of probably a little more oil from Russia comes offline than the US administration is hoping, right? Because their goal is keep the oil on the market and just don't pay Russia as much for it. So those
that's kind of like
have
your cake and eat it wish list. It seems a bit on that. Adi, welcome your insights, and just bringing into that point. Obviously, the news last week of the Ukrainian forces retaking Kherson, being reported by most Western analysts, one has to be said, as some major victory, major change moment. I'm wondering your thoughts on that and what are its ramifications.
Well, I think the war in Ukraine is going very well for Ukraine. I think it was a victory, even though this particular moment was, by many military analysts, expected. Of course, the media made a big deal out of it because simply that sort of side of the river of Kherson was indefensible by the Russian forces. They simply had to move across the river. But it's a great symbolic victory. So I think I wouldn't make it any less positive than it is. Going back to sort of a Russian situation, it's and a price cap. We've spoken about this quite a lot. I've written about this months ago. It's a complete mess, I think. I think all that the governments, actually the G7, under pressure from the US, have done have actually created more uncertainty, more volatility. If anything, I think a part of that price rise last week was due to the fact that we just don't know what the hell's going on, and very much depends on the actual level of the cap. If that level of the cap is, as I expected, turns out to be high enough, then it will be business as usual. Nothing's really happened. Nothing major's really happened. But if it does turn out to be somewhere around $60 in the current market, it will still be the cap will be about $10 below roughly where the Russian oil is pricing at the moment. So it will cause some problems. Particularly the problem is going to be for products, because the shipping side of products is going to be very difficult. I think Russians may be able to find some what they call now a gray fleet of some old vessels that were supposed to go into scrap and use them for shipping their oil elsewhere. And most of the even Aframax you can take quite a long distance. For products, it's a lot harder. First, you've got clean and dirty products. Then you have very differing sizes. It's very hard to mix and match them. So I think we may actually, as a result, see a big fall in product exports. And this is precisely, Sean, why we actually saw a big surge in diesel imports into Europe prior to December the 5th. Not to mention the fact that it's been mentioned so many times in your show and elsewhere that we are trading January oil right now. And December the 5th is supposed to be a deadline, and we still don't have the magic number. So it is quite a mess.
Well, it's certainly, as signaled by Rachel and I think others, that it's all contributes to some disruption from Russian exports, but perhaps it's just another thorn in the side of sanctions that aren't really quite working, but they're annoying and they're problematic, but they're not the knockout blow, and none of it.
Absolutely, the fact, Sean, is that as a result of everything that's going on by the government involvement, we are not going to see more Russian oil. We can only see less.
Yeah, and I think
how much? Don't know.
That at a time when I suppose OPEC is making this fictional cut, OPEC plus, then the Russian piece will maybe be a little bit bigger than its quota share is, or something like that. Let's get the survey question, which addresses this point, and we'll be asking on social media today. OPEC plus should raise oil supply at December meeting as China demand to rise in Q1 with easing of COVID restrictions. Agree or disagree? OPEC plus need to go into their meeting in December thinking about scaling back the cut they've made. I want to talk a little bit about the week that's coming, Rachel, and the obviously continuation of some of the trends from last week, but some of the moments this week to get your views on Biden's first meeting with President Xi of China. Should that create expectations of some sort of, kumbaya moment, or does it reinforce the divisions between the two?
So I don't think it's going to be a kumbaya, loving kind of moment. But I'm the type of analyst that thinks it is better when leaders talk to each other. I mean, because I think there's a lot of both global issues that are in the U.S. interest and Chinese interest to try to address. Obviously, climate change top of mind, but a lot of debt issues throughout the emerging world, and the like. But I don't think the two sides are going to change their minds, and we might see sort of some fiery rhetoric on sort of the sidelines, possibly from both sort of parties, trying to make it clear that neither is yielding. I mean, we can't forget the fact that the U.S. rolled out at the beginning of October some very extensive export controls on China's semiconductor sector, is really trying to keep China from indigenizing its supply chain there, and the like. So there might be some areas where the U.S. again is trying this compartmentalization policy of try to work with China on some things and not on others. But so I don't think there's going to be a grand rapprochement. And I'm also watching closely whether there's actually money and co-investment behind some of the pledges at the ASEAN meetings, at the G20, or is this just a lot of, sort of words? I mean, probably there's a lot of sort of platitudes and some areas towards working together, the US working with sort of Southeast Asia. But if anything, my expectation for the next Congress is the U.S. is going to find it harder to approve new spending, especially in coordination with trusted allies and partners. If anything, on some of these critical supply chains, and that's going to be a little different than the last 2 years.
Would that also impact U.S. spending on support of Ukraine?
I think there's still support for Ukraine. And I think the sort of results that we've seen so far suggest that it will still probably go ahead, maybe at a slightly sort of lower scale. If anything, of course, Ukraine's government from a fiscal support side, not just military, if anything, those needs are getting bigger. And there might be some concern from both progressives and sort of fiscal conservatives on the Republican side to pull back. But I think ultimately the composition here is supportive. I think we'll also see a step up in trying to take those frozen assets that have been seized and to sort of try to get a framework for reconstruction. Now that, of course, is going to be complicated by the fact of sort of allied sort of disagreements. So I think the support will be there. but it might just take a little longer than it's done for some of the latest packages.
Adi, this week also coming, the UK facing its autumn budget statement and signaling some very significant austerity on the way. What's the outlook for that, do you think?
Well, I think it's something that the markets are looking forward to, simply because they want to see a steady hand on the tiller of the UK government. I think the UK government will be very, very conservative there. It will be very austere, simply because they want to calm the markets. At the moment, we are in a situation where the UK is struggling to sell its debt, which is pretty concerning. And I think that will be the key theme. I think it's already priced into the market, and I think it's obviously going to be rather negative for the overall growth, but it will calm down the market, and I think it's a good thing. Just coming back very briefly to what Rachel said about the US policy, I think just as well that we don't have any more stimulus, because I think all of this Fed fighting has been to calm down sort of situation that all the massive stimuli, I guess.
Well, there's liquidity oceans still to be mopped up.
Absolutely. We have the situation
fair enough. No, I don't disagree with you.
We have the situation where you have, essentially fiscal policy fighting monetary policy, trying to calm down what fiscal policy has caused, and that needs to be sort of somehow sorted out, not just in the US but elsewhere as well. So
Rachel, just some closing thoughts. We haven't mentioned COP27 yet, but it's coming to its second week. Any particular takeaways from the first week looking into the second week, and what might be an outcome there worth paying attention to?
Sure. So reason I hadn't mentioned it is that I think probably not headlines that drive sort of near-term market dynamics.
Yeah.
I think, we're seeing some money being deployed. I think this is always going to be a tough one, right? Just because the short-term scramble for energy, including, if anything, more use of coal and throughout the fossil fuel space, is going to make it sort of harder to sort of deploy money over the longer term. A lot of developed countries much more willing to promise technology transfer than to actually sort of live up to some of their spending commitments. So we'll see. We might see some good announcements, but I'm not expecting a lot. Sort of here. And the like. And I think if anything, shorter term, if anything, I think some of the greatest commitments towards sort of boosting new spending on renewables have come from some of the players in the Gulf.
Let's just get our result of the survey vote. Agree here to this point. Adi, just looking and closing comments from you, the outlook for Europe, this sort of energy security crisis seems to have eased, that we're not in a trajectory of worst case scenario, but are we still in very dangerous waters for Europe going into the deeper winter?
Well, I think what happened yesterday, we haven't mentioned, there was an announcement that the Rotterdam refinery workers are going ahead with this strike. And it's a very large refinery, 400,000 barrels. So this is Europe shooting itself in the foot somehow again. And it will exacerbate. It's a big refinery supplying the whole of Europe, especially Northwest Europe, with diesel. It's not a good thing. And I'm just amazed that the company and the governments haven't been able to get together in this current situation to actually agree something. So that's not good, but it's a temporary glitch, I think. Overall, from the gas point of view, gas is the key, and electricity, of course. I think for this winter, bar some very, very major cold snap, I think we should be okay. Now, obviously, a lot of people are thinking about next winter, quite rightly, but let's cross that bridge when we get there. It's a long way to go. Situation in Ukraine is also sort of reaching some sort of settlement, not settlement, but potential for a discussion and negotiation. So we don't know. I wouldn't worry about next year as yet.
You're not the chancellor of Germany, but he has to worry a lot about it, and in doing so is on, I think, his second or third trip to the Gulf next week, is coming, I believe, into Oman for whatever LNG he can pick up anywhere. Clearly, the outwinter, as you say, is the big question mark. We'll have to wrap it up there. Really appreciate the insights today from Rachel Ziemba in the US, Adi Imsirovic in London. Brent crude oil, despite all this drama in which the market's sitting, is a boring 95, up or down $1 or $2, but it doesn't seem to be too perturbed by all of the stresses around, and is sort of firmly stuck in that 90s. I suppose ultimately market's tight, but not overly tight, and so consequently it's comfortable where it is, at least for now, until there's something more significant in the direction of travel. Either China does open or it doesn't, and so forth, some definitive direction, which may come. You wouldn't be surprised to wake up in the morning that China's open. You wouldn't be surprised now. I think we're entering the territory even where a possibility of Ukraine and Russia are meeting in Volta for talks, does seem like we're kind of creeping towards something there. Maybe that's wishful thinking, but the noises around the circumstances seem to indicate that might be increasingly on the cards. Thank you so much. Have a great week, everybody. We're here every morning at 10:30 UAE time. All the best.